So we are in week 3, and it's going to be, let's say, a 5 to 6 week series. I'm building it as we go here. And this is arguably the most common topic that is asked in questions during planning meetings, even on sales calls that I've had recently, which is, hey, am I set up the right way from an entity level planning perspective? I either am a high W-2 earner and I'm buying assets, 1 or 2 assets a year, buying whole rentals, or I'm flipping houses. I might be flipping houses and have a a design services business that services vacation rental markets, or I'm a developer. I've been doing some deals, and I say a lot of developers are kind of well built out, but maybe small flippers who are just getting started. So I like keeping things very streamlined and making sure you get the value out of these, 30 to 40 minutes with me over the next few minutes here. So here's what we're going to cover today, right? So want this to be as impactful as possible for you guys and make sure it's a value add. If you have questions around entity level planning, especially like how do we marry together what I'm hearing from an attorney and then what I'm hearing from a CPA in terms of what is entity level tax planning, which actually, let me do this. If you're new here, my name is Mehek Begeman. I'm a CPA and fractional CFO. We serve only the real estate market. We're a team of 8 professionals, and we are doing bookkeeping, tax planning, tax filings, and fractional CFO services for investors, businesses that are $1 million plus in revenue. So that's who we are. That's what we do all day. So here's our overview: why entity level planning matters. So if I don't have you convinced just yet that you should pay attention, we're going to cover why you should pay attention to this topic. We're going to cover how tax strategy shifts as your business grows. What does it look like to have a disorganized structure versus a structure that's optimized not only for tax planning, but also for asset protection? Again, I can't specifically speak to asset protection in of itself just because I know a lot about it, but I'm not an attorney. I am a CPA. So therefore, talk to your own legal counsel to make sure you're protected on asset protection. I will speak to this generally speaking from an educational perspective on tax planning and how to optimize your entity setup for tax planning. I don't have you convinced just yet. Let me tell you why entity level planning does matter, or single member, multi-member, S corp, those kinds of questions. Why does it matter? So we want to optimize your asset protection, meaning we want to keep your attorney happy, but we also want to minimize your tax liability. An example of this would be a situation in which you might have an attorney who is advising, for whatever reason, that your rental, either single member LLC or multi-member LLC, should become an S corp. They might say, hey, it's great to become an S corp. You probably want to backfill with your knowledge gap there with a CPA who actually knows how taxation works in S corps, because you're going to be up against something called built-in gains, and it locks you into an entity structure, and you can cross-collateralize your assets when rentals are held in an S corp. So you want to make sure that your tax counsel and your legal counsel are working for your good and you're not getting mixed advice from 2 different advisors. Again, your entity structure can also provide some audit protection. And I say that to say, is there more audit risk with a certain entity type? Yes and no. But what I'm getting at here is as your operations grow and you have shared costs between different entities or different, you might be co-hosting over here and you might have your own rentals over here. Well, you need to be able to have clean records and also be efficient in your operations. So there's ways to tackle that without having multiple bank accounts, all the different nuances that come with running different entities and multiple legal entities in of itself. And then we want to make sure that the structure today that you're setting up is going to support your long-term goals. So said another way, if you might only have 2 or 3 assets right now, but you would like to add 1 to 2 buy and holds every year, or in other words, maybe you're flipping 5 houses a year, you would like to flip 30 houses a year. You want to have the foundation set up in a way that you can scale from there without having to go through this entire process every time you start a new revenue stream or a new arm of your business, right? So you kind of want to think ahead on how to be structured best. So I was a little bit ahead of myself here. So as your business grows, we want to make sure that you're mitigated on your tax risk, especially as your income is going up. Your entity structure does impact your tax efficiency. We're going to talk about S corps in just a minute. And then as your income goes up, whether that's W-2 income or your business income, you have to be more proactive in tax planning. Otherwise, if you watch last week's live, you'll notice the training that we went through last week. It draws a comparison between a single member LLC tax on all of the income versus an S corp. If you're a trader business, you might want to go back and watch that training because it was it draws a clear comparison between being proactive in planning versus being reactive in planning, and how much percentage profits you end up paying to the IRS. So here's the meat and potatoes, right? So you're like, okay, give me some action steps. I want to know, if I'm a single member LLC or I'm a sole prop, how am I taxed? What should I be thinking about? So you'll see 3 buckets coming up here. We're going to go through sole proprietorship. Single member LLC is another way to think about it, actually slightly different. I'll cover that. Partnerships, S corps. Where does it make sense? How should you be thinking about your structure? So a lot of times I see mom pop flippers, or maybe you offer some design services, maybe you are a co-host, anything, right? A lot of times people start doing business in their own name under their social security number. If that's you, you're a sole proprietorship. It's a pretty simple setup. Might even, or maybe you could do some contract work for somebody. Maybe you have a full-time job, maybe you just do it on the side. Nonetheless, you basically get a 1099 in your name, and then you take that to your tax return, you report it there, and if you're starting to make 15, 20, 30, 50K on the side, this is a side hustle, maybe you do some design services in your spare time, then you're going to start picking up a heavy amount of tax burden, especially if you file jointly with a spouse and are starting to hit, 150, 200K of taxable income. You're, in my example here, and I'll talk about rentals too if you have rentals in your name, but if you have ordinary income, similar to business income, what I just described, then you're starting to pick up a lot of the self-employed tax exposure, because you are now required to pay the employer and the employee side of your taxes, right? So not only are you picking up the tax burden on the employer side, you're also picking up employee side tax burden, which would otherwise be paid by your employer because you're self-employed. And then of course, from a planning perspective, if, we've had this happen to us before, where an owner wanted to make an S election in a given year, but she was doing rental arbitrage, and she was running that under her social security number. So we cannot actually make an S election when there's no legal entity in place already. So let me unpack that. If you've been running your business under your social security number, meaning you're not a single member LLC with a federal tax ID, then the LLC is what makes the S election, not you, the person. So we actually moved hers from a sole proprietorship to a single member LLC, which can then make the S election in the following tax year. So that is a prerequisite if you're thinking about making an S election. So let me close the loop on what I said earlier, which is, if you are holding assets in your personal name and you're worried about SE tax on rental real estate, you are okay. The reason is that rental real estate is considered passive from an income tax perspective, and so that rental income is not taxed at the self-employed level to begin with. So it's very common for our clients to own rental real estate in their personal names. The tax benefit is not negated because you're owning assets in your personal name. Your attorney and or any legal counsel might advise you to have an entity structure that helps you be more anonymous, especially in the case of a lawsuit. I would say that in most cases, when we are setting up a Wyoming entity that a single member LLC or a multi-member LLC flows up into, there's no additional tax benefit. It really is more of an asset protection play, which I advise, especially if you're high income or have other assets that you need to mitigate the risk on. Hopefully that's not a gray answer. I get that feedback a lot too, which is I wish somebody would just tell me plain and simple, or simplify it. Obviously there's nuances in planning, but simplify it in a way that makes sense to me as to whether or not I need a Wyoming entity in the mix. So the next leg of the journey here, we're going to talk about LLCs. And when it's an election, so LLCs by default, I'll tell you how they're taxed, and when should you make an S election for a legal entity. So this is the most flavorful because you can be single member, you can be multi-member, you can be single member as an S corp, or you can be a multi-member as an S. So you got a lot of different flavors you can choose from. When does it make sense for you to be single member LLC? I would say in most cases, when I've got a single taxpayer who is the sole owner of assets or sole owner in their business, the single member LLC structure makes a lot of sense. They are the only one who has vested interest in the assets in that entity and or the income generated from that entity. My professional advice on asset ownership when there's couples involved, and I was having a conversation with one of my friends within the last year who was going through a divorce, where you want to make sure that either your obviously community property states rule in the event of a divorce, but nonetheless, my cadence on asset ownership is that don't be cheap in asset ownership when it comes to legal entity formation. So if you're buying an asset that's 300,000, 400,000, 500,000, you're both on the debt. Let's go ahead and place that asset in a two-member partnership. Let's not get cheap on, oh, a single member LLC does not have to file a partnership return, whereas a two-member LLC would have to file a partnership return, which is additional cost. I just want to see things clean and clear, especially in an event that the asset is liquidated. I just want there to be an operating agreement that guides what happens in the event of who has the ability to liquidate that asset, when it liquidates, how does it get paid out, just all of the fine details of partnerships that need to be discussed, not only from a tax perspective, just from a life perspective as well. Rental assets generally need to sit inside of a two-member LLC for spouses that own assets together, tax as a partnership. I alluded to this earlier, but 99% of the time, we are not going to want to make an S election for any two-member LLCs that own hard assets, including rental real estate. The reason is that this concept of built-in gains, which is, let me simplify this to where it makes a lot of sense to anyone that's watching this content, consuming it, and wants to understand what that. So us corporations are going to recognize when the building is bought, it recognizes the building at the cost basis. So let's say you paid $500,000 for the asset, you did $50,000 of improvements. On your books on the balance sheet, that asset is going to sit at $550K. So let's say 3 years pass by and you're like, man, I have all this equity in this deal where I can take some of the equity and go buy my next deal. So let's say market's gone up to 800,000 now, and there's a delta between 550 and 800. So there's some untapped equity that you could tap into, then go buy your next asset. However, because you're inside of an S Corp, should you cross collateralize, you can certainly take debt against it, and you would have to distribute that out to you and or buy an asset into the S Corp. Reach out to me if you have questions on that. But if you were to move this over out of the S Corp, let's say you're like, hey, we're going to move it out of 123 Main S Corp into Melissa and Doug two-member LLC, then you're going to effectively create a taxable gain at the S Corp level because you're moving this asset and realizing the gain. And that is actually very unfavorable, right? Because now you have a phantom gain on paper, but no cash to actually pay the tax bill on essentially this liquidation of asset. And you might even say, well, it's actually not liquidating. We're just moving it from over here to over here, same ownership. Melissa and Doug over here, shareholders, Melissa and Doug over here. Two-member LLC, what's the problem? Problem is this concept of built-in gains. So there's no gain happening just yet. It's built in, but the delta between the market and what's book value, that gain gets realized, which now triggers a taxable event for you. Can you mitigate it? Absolutely. There's ways to mitigate it, to think outside the box, get creative, to really tap into that pent-up equity. But you can see how this starts to create some issues as it relates to being able to move things around on your org chart from an asset perspective. Now, where does S Corps make a lot of sense? Most of the time when it comes to anything that's services related, I'll give you some concrete examples. We have a client who does rental arbitrage for construction workers. They're an S Corp. We have a client who does some arbitrage for insurance companies. Again, arbitrage businesses are very well fit for this. Design services, my firm, CPA firms, lawyers are structured this way a lot of times. They're partnerships. Then our builders, a lot of times when there's ordinary income, flippers are structured this way. The only ones sort of in the real estate space that are excluded, it's not a good planning tool for, is small landlords that are holding, buy and hold rental real estate. So hopefully that simplifies your decision tree on where the S selection makes sense. So I kind of covered that. Let me recap it super quick. So trade or business income, that's consistently, I should touch on this. So I do think that there's something that I think is true for some of my owners who maybe consume some of my content and come back and say, hey, I'm ready to make that S election. My first question to them is, hey, how much is your profit? Like, how much are you in profit year over year consistently, especially if you're a new business? And my threshold is somewhere between 60 to 80K of profit. It is not inexpensive to be an S Corp. You have to run payroll. You have to take reasonable salaries. You are mitigating your SE tax burden, but I just want to make sure that this is a net positive and you're not going to be frustrated with this S election because now you have additional compliance and the cost to run payroll. And at the end of the day, you're not saving that much in taxes. So there is a decision tree that you should go through with your CPA to make sure that S election actually makes sense for you. The other one that I get very excited about, not only for traditional retirement planning, but retirement planning with the mindset of how can I leverage retirement planning to then build sort of springboard my real estate portfolio, right? So I get really excited about that, which is retirement planning is important to you. And it's part of your owner target to have either money in traditional retirement or have money in self-directed accounts that you can do some private money lending out of. Or of course, you got to be careful with UBIT as it relates to retirement accounts. But if you have an appetite for that, I think S Corps are an excellent strategy for earning income where business income is involved. And then the third one, thinking a little bit of longer term, right? So maybe you started your business, your banker knew you, or you had a customer relationships, you really kind of bootstrap this thing and you're starting to build it out. Well, eventually you're going to want to create some business credit, business credibility and bankability. You're going to want some standalone financial statements, some standalone tax returns, not you, the person, but you, the S Corp, you, the business can qualify for loans and for debt and being able to establish credit and like all the good things that come with it. And let's take it like zoom out and take it even further. If you were on the mindset like, hey, I'm going to build this thing, I'm going to build it to sell, then even more so, there's some additional things that we need to think through to set you up in a way that you have what it takes for your EBITDA and some of the KPIs that an owner is going to look at to buy you out or buy the entity out in the contracts. There's a little bit more there to make sure you're set up the right way. And then you could actually exit a net positive sale and have the outcome that you want, especially if you're wanting to exit from a sale perspective. We covered this in depth, but to hit some highlights as to when S Corps don't make sense, it's going to be the early years in business. You're just getting started. You don't have ongoing strong potential for profitability. You're just trying to pay yourself, make sure you can take a paycheck home and take a distribution. It's a one-off JV deal. You did a deal with somebody. You don't think you're going to do a deal with them again. Don't tie yourself into an S Corp. I've actually had a recent conversation about this with an owner who thought they were going to have this really strong partnership and do a ton of deals together. They made the S election this year. I wish they would have waited. Fizzling out. Not that they don't like each other. They're just not going to do as many deals together. Buy and hold real estate, big X. Let's not do that. And then here's the other sneaky one. If you and or your spouse have high W-2 income, there's actually, because this strategy in of itself mitigates SE burden and create payroll. Let's say you have a spouse who makes $250, right? So if you have a business over here and you put yourself on payroll, I say this tongue in cheek. There's strategies to be able to create payroll to where it actually mitigates some of your tax burden, meaning you get capped at a certain, I think it's 187K is where you get capped on FICA, state on Medicare, and Medicaid taxes. I know it adjusts, so I may be a little bit off on that, but you have to think through this a little bit carefully and model this out. I mean, we work off actual numbers and not guesswork on how we model things out for our clients. So just be mindful that it's not just a yes always. When it comes to S election, it may not make sense if you're already in the highest tax bracket, and creating additional payroll probably doesn't make sense because you might be getting limited on qualified business income deduction or other phase outs that are not as visible without doing the planning on it. Okay, and then so this is the last kind of big piece, which is most of the time, our clients are going to be set up this way, especially those who have buy and hold real estate or those who are raising capital to do deals. They're going to be structured as LLCs, multi-member, two-member, multi-member, either way, that are taxed as partnerships, where all of them, and this is kind of the ideal fit and I'm thinking about our clients who are raising capital. They might have 12 partners, 8 partners, 5 partners, friends and family around. They're pooling resources together. They're raising capital, giving everybody percentage ownership, and then they're buying buy and hold real estate in that entity. A lot of times it plays out a couple of different ways, meaning for friends and family around, or maybe you're buying with your son, your daughter, with your spouse, you may be buying with a parent, with outside partners. You might have a holding time of 5 to 8 years, and then you exit, or and operating agreements. I love those, especially in partnerships. You can structure these however you want with careful thought, of course, but you can buy out your partners at a certain point in time, especially if you're planning on letting the asset appreciate. Maybe you're the GP in the deal. You want to have the opportunity to not be forced to sell in year 8. You want to have the opportunity to be able to refinance that deal and then be able to buy out your partners. Then when you're forming the entities, you want to think through this carefully and not just leave it up to chance on the back end. There's flexibility on allocations. This is also another great benefit for partnerships to be able to play out, of course, with husband-wife 5 partnerships, doesn't matter as much because everything hits your 1040 if you file jointly. I see this as an added benefit for unrelated parties if you're doing deals together, is that maybe you're the managing member, maybe you take on the more risk, or maybe you brought most of the capital. And so you want to be able to take the depreciation on this asset. Of course, make sure, asterisk on this, that you can actually take the losses. You're not going to get limited by basis or limited by passive activity loss rules. So you want to double check and make sure that the way the contract is written, the operating agreement, actually makes sense. But there's a lot of flexibility. It doesn't have to be 50-50 or 60-40 or 75-25. You can have profits and losses shared one way and depreciation shared another way. It's called special allocations. So there's a lot of flexibility, which we appreciate, especially as we're doing tax planning for our clients. And then, like I said, the SE tax may be already mitigated in this case, right? So if you're a group of owners and you have buy and hold real estate, you might hear somewhere on TikTok like, hey, you should be an S Corp. But in this case, it actually doesn't make any sense, because if you have buy and hold real estate, then you already aren't subject to SE tax. So by making the S election, it actually does not create any additional benefit for you. It actually is more beneficial to be a 2-member or multi-member partnership because there's no SE tax to mitigate in the first place. So I hope that was helpful. All right, we're going to keep going. This slide is arbitrary, meaning it's set up to showcase what I call a messy structure looks like, where your cost of compliance is going to be higher than it really needs to be if you were well optimized for the entity structure perspective. And I kind of drew this out with keeping in mind what I see on average with our clients. So in this messy structure, you have owners Sam and Missy. They own 4 legal entities, 1, 2, 3, and 4. I'm not very creative with naming. And they own some personally held assets. And they also have the single member LLC that does some design services. So in this structure, you'll notice that they're going to have this 2 members, right? Sam and Missy. They're going to have 4 partnership returns at the very least. They're going to have a partnership return on LLC 1. LLC 2 is going to have a partnership return 3 and 4. So 4 partnership returns, and the rest of it is going to be filed on their personal income tax return. Now, in their case, they could structure this just by moving things around on their org chart. They can clean this up. Now, they're going to be paying some decent amount of money for just tax compliance, which is us. However, they don't need to pay all that money for tax compliance alone with IRS to have full partnership returns filed in this org chart. So let me show you in this case how you could optimize. And let me reiterate, we are not a law firm. We do not set up entity structures. We guide on tax implications of entity structures. But if we were to optimize the structure from a tax perspective, this new structure probably is a little bit better, right? So let me walk you through this. Now, in this case, Sam and Missy, they still have the single member LLC. They're making, I forgot to mention, I wanted to tee myself up. The single member LLC is making $100,000 in profit. So we're going to optimize by making that S election over here. And then we're going to negate some of these individual partnership returns that have to be filed down here by setting up this holdco that is a parent entity that 100% owns all of the children LLCs underneath it. And you'll notice too, if you look in the previous structure, these personally held assets were down here by themselves, and then it was kind of a mess. So now the holdco is able to report all of the activity at the holdco level, 1 partnership return, not 4, 1 partnership return, and then 1 other business return. So you end up having 2 business returns that are K1 flow ups to you at the personal level. And again, all income and expenses flow the same way, but have effectively reduced your compliance cost by structuring things a certain way and not having you file 6 tax returns, which would be 4 partnership returns, 1 S Corp return, and 1 personal return. So we've pared that down to 3 tax returns, your personal, the partnership, and the S Corp. So very simple case study, but wanted to give you a visual on why it makes sense. So here's the key takeaways. Your tax strategy, it has to evolve. If you've been working with the same accountant you started with and you are now 15 assets in, maybe you made 50K when you started and now you make 250 or 300 and you feel like you've outgrown your tax accountant, it's time for a change. Your entity structure is foundational. So if nobody's looked at your entity structure and or is avoiding questions around it, you're probably not with the right professional. And then of course, you have to do some proactive planning. You're going to pay the price either way, right? So either you have no proactive planning, end up getting hammered on your tax bill come April, or you can get better systems and processes in place, have a good bookkeeper, or hire somebody like ourselves who can integrate all the services, really actually know where your numbers sit, do the model analysis with us. No, I just had a call earlier today and we were talking to this owner who has 5 different partnerships with his wife, single member LLCs in the structure to mitigate multiple filings, and knows exactly how much he needs to put aside. Actually, he has money sitting aside already for his tax bill and they're renovating their personal residence, their new personal residence. And I was joking with him because I was like, hey, actually Taylor can have the nice kitchen now because you've got an extra 30K sitting there that you're not going to need for your tax bill. So sounds like she's going to get the kitchen she wanted because you're going to have some excess cash sitting in that tax account that you're not going to end up paying to the IRS, which is what I want for you guys. So what's next? Here's your next steps. Here's your call to action. If you haven't looked at your entity structure, you've got a lot of loose pieces floating around. You don't even know why you have the entity in the first place. Maybe you set it up and you're paying some sort of state filing fee on it. You need to take a look at your current entity structure and pare things down, close things out, regroup things, move some stuff around, get it to where it's optimized. You need to identify some planning gaps, and you may not know what exactly are the planning gaps, but as an owner, you know that you're not optimized on your planning. You know, most of my clients, when they cannot get on a call with me, it's not so much me showing them where they're missing the mark. It's they know they're missing the mark. They just need help. And then if you don't have anybody in your corner who's doing tax planning at this level for you, then you need to schedule a call with us. So when you schedule a call with us, or if you'd like for us to audit, we can audit your current setup. We can propose a way to get it cleaned up and then map out what a tax optimized structure actually looks like for the 25, 26 tax year. My team did an amazing job, but 25, 26 tax year. So small mistake there. And then if you're like, hey, I'm ready to take action, tell me what's next. The link is live. I'll also post it in the description that is going to post once this live is done uploading. And then you can click and book a call with us, which will walk exactly through what we talked about today, get eyes on your current entity structure and propose some changes to optimize from a tax perspective. Awesome. Well, I hope this was super helpful. I hope that you took the notes. There's some things that maybe stood out to you that are like top 3 that you need to go take a look at. And then if you need support, please reach out. Otherwise, we'll be back next week. Talk soon.